216 points sounds a lot better than 0.76%. Okay, so that's what tonight's lecture is all about. Right? Because everything we do for the remainder of the semester, we have to be cognizant of the biases that we have. All right, so let's hop into it. So we're going to talk tonight the key concepts and skills of behavioral finance, right? Things such as overconfidence, over-optimism, confirmation bias, self-attribution bias. All of these things can impact our decision-making process. We're going to talk about how framing a question or framing a response can result in both inconsistent and or incorrect decisions that we're trying to make, right? You guys are all familiar, are you familiar with like the decision tree methodology, you know, where you're faced with a decision and then you've got a, you know, you've got a yes, no, and then from that next decision, you've got another yes, no. So you've got a 50% probability of being right on that first decision. But then if you expand it out, you've got a 20% probability of being right on the next level of decision making that you're talking about. Okay. How we go about making decisions is crucially important. We're going to talk a little bit about heuristics, which are more of like, you know, rule of thumb type decision making. And then finally, how does behavioral finance relate to the efficient market theory? Okay, what, as my 14-year-old son would say, what even is that, Dado? What even is efficient market theory? Okay, we'll talk about that. So the first thing we have to figure out is, what is a poor outcome? Well, obviously a poor outcome is something that we make a decision and the outcome is something that we totally did not expect, right? And it stems from one of two things, right? First, you actually made a good decision. You made a good choice, but something external happened that negatively impacted that choice, right? Anybody have a good example of that from what's going on right now? Go ahead, Liam.
You could say the whole coronavirus situation. Let's say you invested in a stock that was doing really well with all of its assets and its management, and it had, you know, good leaders in the company. But just because of the whole coronavirus situation, the investment that you initially made didn't do as well as you thought it would.
Excellent. And on that note, let's go ahead and look at one. That's a very good example. All right. Let's see. Let's take a look at something that supports that exact theory. Norwegian Cruise Lines, the largest cruise ship company in the world. And let's take a look at what happened over the last 3 years. Look at that. See that graph right there? Right? It was trading at an average of about 50 bucks, right? Trading an average of about $50 for the last 3 years. And then all of a sudden, boom, Corona hits, right? And the cruise industry shut down and their stock dropped to $8.46, okay? If you had bought Norwegian Cruise Lines back here in December of 2018 at $40.79, in that time frame, that's a really good price to buy it at. You bought it at a low. All right, but then something external happened and that good decision now has a poor outcome. Okay, so that's a great example. And then the one that we never want to admit to ourselves, sometimes we just screwed up. Sometimes we just made a bad choice, period. We had a cognitive error, right? And I hate to tell you, we all need to take a deep breath and admit to ourselves sometimes when we just made a bad choice, right? I made a bad choice marrying my ex-wife, but I got 3 young kids out of it, right? So would I go back and do it all over again if I could still have my 3 kids? Of course I would. If my kids didn't exist, hell no, I wouldn't make that choice, okay? But sometimes you just make a bad choice and we deal with the poor outcome afterwards, all right? So the other thing that you're gonna find is sometimes I do take tangents. right? And I do have a tendency to bring up my ex-wife from time to time, so don't judge me. There's no judgment zone. So what does IQ stand for? Anybody remember? What does IQ stand for?
Intelligence quotient.
Yeah, intelligent quotient, right? How smart you are, all right? You've got an IQ of 120, all right? You're an intelligent individual, all right? You, yourself, me, I have an IQ, you have an IQ, but that revolves around you, all right? So when we talk about IQ, we're talking about ourself. And we think about that in terms of an awareness versus management standpoint. When we're talking about the intelligence quotient, we're talking about how self-aware am I? Okay, how am I doing? How are things going on in my world right now? How am I managing everything that's happening with the coronavirus? How am I managing my school schedule? How am I managing coaching soccer, being a dad, you know, running a company, teaching at 2 universities? How am I managing those things? But it's all about yourself. So in 2002, a gentleman by the name of Daniel Kahneman, right, came up with this theory that how our emotions come into our relationships is actually really important with how we go about making decisions, not only in our personal life, but also our financial life. Hence the advent of emotional intelligence, right? And eventually it moved from, you know, a more qualitative theory into a more quantitative measure. And what it does is it looks at how social aware are we? We take it from ourself to the social component. So instead of on an awareness standpoint, how am I doing? We flip that around and we look at the lens through society and we say, how are the people around me doing? Okay, how are the other people on this lecture tonight doing? How are they managing what's going on? Okay, it's a very different conversation, right? How do the decisions that I make impact others? This is a big one, all right? If you're in a relationship right now, this is probably the biggest one. Is my wife understanding what I'm telling her? Okay, I use that word telling for a reason, as opposed to, is my wife understanding what I'm trying to communicate to her? Okay, people receive things differently, all right? And it's important to understand in relationships, how do the words that I use, how are those received by other people? Now, in the real world, it becomes really important, because if you're in a meeting and you're surrounded by accountants and finance managers and a natural gas trader, guess what? They all speak a different language. And so you need to be able to communicate effectively in a way that they're going to understand. Okay, and we'll talk more about those things later on. Okay, so IQ is about yourself. EQ is about the social aspect, the other people. All right, so one of the first biases that we're going to talk about is overconfidence. Right? Statistics have shown that about 80% of us feel like we're above average drivers. Right? If I polled the class right now, probably about half, at least 70%, 75% of you would say, I'm an above average driver. Okay, but the reality of it is we're not, because if we were all above average drivers, guess what? Our insurance premiums would not be as high as they are. Okay, it wouldn't matter what age we were. It wouldn't matter what kind of car we drove or how old our car was. None of that would factor into the insurance premium cost. If we were all above average drivers, then the insurance premiums would be low. So it's not true. Okay. Also, this belief that the markets always go up, we're overconfident that we're always going to make money on our investments, right? That is simply not accurate. Now, I could show you a graph where since 1930 to, you know, last year, if you did a regression analysis on the market, yes, one could suppose that the markets always go up. But you'd also see some big moves up, and you'd also see some big dips down, right? So if you're willing to keep your money in, then maybe you might have that shot of your money always moving upwards. Okay. The problem is that business decisions that we make, choices that you guys are having to make right now, about what classes you're going to take next semester or next year, or where you want to live, or what job you want to have, all those decisions that you're facing, they require some sort of judgment on an unknown future. Okay. So overconfidence can result in assuming that our forecasts might be a little more precise than what they actually turn out to be. Okay, so just keep that in mind. So how does overconfidence relate to the markets and trading, right? So it's shown over a long enough period of time that overconfidence by investors actually leads to an investor's thinking that they are great stock pickers. And I'm here to tell you that picking stocks is a loser's game, okay? Because it leads to excessive trading. If that stock starts to go down, we don't like to take losses. So maybe we sell it, but we sell it at a point that it was too early to sell, and the stock turns around and moves up 30%. So excessive trading, being overconfident, can lead to bad decisions, right? So most of the time, investors wind up hurting themselves through investor trading or excessive trading. And lots of work has been done on this third bullet here. Accounts that trade excessively typically are the ones that underperform the ones that don't trade excessively. Right? Ladies, you win, right? You have proven time and time again that when you put your money in the market and you develop a plan and you stick with that plan, you do not trade excessively, and your portfolio will typically outperform those of us excessive trading gentlemen. Okay, so sorry guys, but the ladies statistically have beaten us on portfolio returns simply because women tend to stick with their plan more than guys do. It's proven. It's not my opinion. It's actually statistically proven. Over optimism. Okay, here's another bias that we've got, right? So one of the, in my job, and certainly in my former job as an engineer, we were responsible for implementing, building new projects, all right? We were asking the company to give us hundreds of millions of dollars so that we could take a grass plot of land and drop a chemical plant on top of it, okay? Which meant that chemical plant better produce something that we can sell, right? And we have a tendency to get very vested in the projects that we work on like that. And maybe we're a little over optimistic around what kind of revenue that project is going to deliver, okay? So we project cash flows, all right, that are a little higher than what reality is. And when we get to the conversation around time value of money, we're going to have this conversation around NPV, or net present value, right? Which is the process with which we go about taking some future stream of cash flows, bringing all of those back into today's dollars and comparing it against the cost of the project. Okay, we're going to look at what that means. Okay. And in most cases, because we are vested in the projects we're working on, we have a higher likelihood of overestimating the likelihood of a good outcome. Right? So when we're out there in the real world and we're working on projects, budgets, okay, it's important to be aware that over-optimism can lead to, an overestimation of a potential outcome. Okay. The third type of bias, confirmation bias, meaning that more weight is going to be given to information that agrees with a pre-existing opinion, right? We spend too much time trying to prove ourselves right rather than researching things that might prove our theories wrong, okay? Simple example here, okay? You got a neighbor who just has this natural opinion that all dogs are dangerous, okay? and he sees a dog interacting with a child in a vicious way, right? What he sees is that the dog is attacking a child because he believes all dogs are inherently vicious. The neighbor on the other side believes that dogs are nice and gentle. Okay, so it's not the dog's fault. The child's just acting like Dennis the Menace and tormenting the dog. Okay, so confirmation bias. Okay, framing, right? This is a big one. How a question is framed can impact the answer given or the choice selected. All right, what do we mean by that? So, you know, one of the big discussions right now in politics and in the media revolves around gun control, right? And you have a group of people who want to ban one particular type of firearm, and you have another group of people who don't want to ban a particular type of firearm. But the way that those get framed are two very different themes. Okay, so the word that a certain group of people would use is, we want to ban all assault rifles, right? Versus the other side, which might say, we'd like to ban, okay, using a different word, long guns. Okay, they're talking about the same item. Okay, but the words that they use frame the question in such a way, right, that can elicit a very different answer from the people who might be taking that poll. Okay, so the reason why I bring that up is because you see polls all the time. You get NBC polls. Goucher College has a poll. They do a pretty good job, actually. I'm pretty impressed with their polls. NBC polls, Fox News polls, CNN polls. When you see those polls after this class, I hope that you'll take a moment to read the words a little bit more and see if they're trying to get you to answer the question a certain way based upon the way that they're asking the question. Okay. Loss aversion. This is a big one. Okay. We don't like losses. All right. Most of the time, if we have a loss in our portfolio, we believe that, oh, you know, we'll just hold on to it for a little longer because it's going to get back to break even. I would call that the break even effect. Okay, so we retain these losing investments far too long, which is a direct violation of the sunk cost principle, meaning the money's already gone. You already spent that money on the investment, okay? So you can't look at it that way. It's already a sunk cost, right? House money. We're more likely to risk money that's been won than that which has been earned, okay? If you go to Vegas and you win, you're more likely to try to continue betting to continue winning more. Okay, even though both of those things represent wealth, whether you won it at the Pai Gow poker table or you earned it through the sale of a product. So let's get into an example of framing. Right? So we've got this example where we've had this natural disaster happen. Speaking of disasters, good Lord. Anybody see what happened over, was it Tehran? Was it Tehran where the big explosion happened? No, it wasn't in Iran. It was Beirut, all right? When the big 2,000-pound sacks of ammonium nitrate exploded and basically decimated the entire city of Beirut and put a 160-foot hole in the ground, okay? So a disaster has occurred. And we've got 600 people that are at risk, and you've got to make a decision here, right? And you've only got two options, option A and option B. Option A, exactly 200 people are going to be saved. Option B, there's a probability, a 33% chance that all 600 people are going to be saved, but you've got a 66% chance that nobody's going to be saved, all right? Which one would you choose? Hit the chat room. Option A or option B? A, B, A. we're at 66, 70, 80, 80, 90, 90, 92, 93, 94. Okay, so we're going to call it into the 90% of the class, right, is selecting option A. All right, so option A is exactly 200 people are going to be saved. All right, so keep that in mind. So I'm going to write that down, option A. Now, let's look at a different example. Same kind of thing, disaster happens. We're still talking about the same 600 people at risk. Now we've got option C and option D. Option C, exactly 400 people are going to die. Option D, 33% chance that nobody's going to die, and a 66% chance that all 600 will die. Which one do you pick now? D, 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 C, C, 50%, 60%, 70%, 80%, 85%, 90%. Okay, again, most of the class right now has selected option D, all right? A third chance, 33% chance that nobody's gonna die, and 2/3 of a chance that all 600 are gonna die. Framing. Guess what? Option A and option C are the exact same option. And option B and D are the exact same options, okay? Option A was exactly 200 people are going to be saved. Option C was 400 people are going to die. It's the same number. 400 people still died in option A, and 200 people were still saved in option C. But how we framed it made a difference. Why? Because we want people to be saved. We want people to live, okay? So even though 400 people still died in both options, how we framed that option made a big difference, okay? So keep that in mind. The framing makes it appear different, okay? So let's talk about loss aversion. Suppose I were to give you $1,000, okay, and you got the following choices. In option A, you're guaranteed another 500 bucks, guaranteed. Option B, you can flip a coin. If it comes up heads, I'm going to give you another 1,000 bucks. But if it comes up tails, you get nothing, right? What would you guys pick? Guaranteed 500 or 50-50 on doubling your money or not getting anything? I like to gamble. Kyle, yeah, I like you. That's great. A. All right, so a little more evenly split this time, but still predominantly the answer A. We like that guaranteed gain, right? We want to be guaranteed the 500 bucks. All right, at least we know we're guaranteed to get something. All right, scenario 2. So again, 50% gain if you chose option A, guaranteed 50% gain. Scenario 2, I'm going to give you $2,000 this time instead of one. Option C, you're guaranteed to lose 500 bucks. Or option D, you flip that coin again. If it comes up heads, you lose 1,000, but if it comes up tails, you lose nothing. C or D? Uh-huh. Yep. More D's are coming in. Oh, there's some C's. Oh, there's some C's, D's. Okay. Almost evenly split down there. Okay. So again, when we look at it, about 85% of the people who are posed with those scenarios are going to choose option A. They want to lock in that gain. So those of you who chose option A, you're in that 85% of the statistics. All right. And then 70%, slightly lower, and that's kind of representative of what came in the chat room, who are presented with the second scenario, choose option D. All right. But if we look at it, A and C are the exact same thing, and B and D are the exact same thing. The difference was we didn't want to be guaranteed a loss. We wanted to be guaranteed a gain, but we don't want the losses. So when we focus on the gains and the losses, instead of the overall wealth that we're talking about, okay, that's when we get into the concept of narrow framing, and it leads to the bias that we call loss aversion, okay? And that loss aversion is also known as the get even or break even effect, okay? So another one, we've got two investments that you're making. Okay. The first investment, you bought a company called Moore Enterprises. Sounds like a flooring company to me. All right. You bought 100 shares at 35 bucks. So you've got a total investment of $3,500. All of a sudden, the shares immediately fell to $20 a piece. Okay. So you lost $15 a share times 100 shares. So you're kind of in the hole 1,500 bucks. So you've got a $1,500 loss on the books. At the same time, you made an investment in Miller Company, the champagne of beers. All right. You made an investment in Miller, 100 shares at $5 a share. And then all of a sudden, because you're awesome and you picked it right, that popped to $20 a share. So your $500 investment went to $2,000, which is a $1,500 gain. Okay. So follow along. You got a $1,500 loss on Moore, and you've got a $1,500 gain on the champagne of beers. So you might be going through a thought process of telling yourself that Miller, man, that was a great idea. You are a genius. You're a genius. You picked the right stock and it quadrupled in value. Way to go. And then you might be telling yourself that the drop in value on those Moore shares wasn't your fault. Something bad happened. It wasn't my fault. I was a good pick. It was something external that created the poor outcome. Okay. This is what we're talking about when we talk about confirmation bias and self-attribution bias. When things go right, we take credit. When things go wrong, we sometimes blame somebody else or some other external event for the poor outcome. So you might be inclined to sell your winner, right? To sell Miller in order to lock in those gains. But guess what? You're more inclined also to then hold on to your Moore shares in the hope of avoiding the losses, all right? So that is the loss aversion bias that we just went through. Okay, so this tendency that we have as investors to harvest our gains, all right, and not capture the losses, we call that the disposition effect, right? Where the most rational thing to do in this scenario is to determine whether or not the prices of those two entities are fairly valued, right? And if they're fairly valued, then react accordingly. Maybe it's a great time to add to your position, all right, in Moore, okay, to lower your cost basis. Or maybe it's best if you go ahead and sell some of those shares to capture some of those losses so that you can use it on your taxes to offset income, right? Having a loss is not necessarily a bad thing in all cases. So just a couple of other, types of judgment errors. We have myopic loss aversion. All right, this is where we buy maybe a speculative company that has really high growth potential, but we might have to deal with a period of time where we're suffering some losses within our portfolio just in order to get some of those large gains out the curve, right? But sometimes we get so scared of those short-term losses that we go ahead and dump it at the expense of those long-term gains. So we have a myopic view of the market and we're making decisions through that myopic lens. Regret aversion. This is a big one, okay? The unwillingness to make a decision because you're afraid that you might be wrong and you would regret the decision that you made, okay? So instead, you don't make the decision, right? You're avoiding the possibility of regret around a decision that you might be making. All right, that's a big one. We all do it. I do it. Okay, but that is a big thing in our decision-making process. Regret aversion. The endowment effect. I have a few clients like this that they think that just because they own it, that it's actually more valuable than what it actually is. Okay, whatever. An autograph from the talk show host Ellen, all right? Maybe you have one of those and you feel that there's significant value in that. Well, the reality of it is it's probably not as valuable as you think it is, right? That's the endowment effect. And money illusion, we're not really going to talk too much about that. All right. Heuristics, there's just kind of mental shortcuts that we make, representative heuristics, where we rely on the stereotypes or limited samples to form opinions about an entire group of people. Okay. Representativeness and randomness. This is just a slide to introduce you to kind of what heuristics are and how sometimes our rules of thumb can break down and they don't always apply to the larger population of people that we might come in contact with. All right. So how do those biases, how does behavioral finance, how we feel about investing, how we feel about gains and losses, how does that relate to how the markets are priced? Right. So, market efficiency. If we believe that the markets are efficient, okay, it means that every investor has access to the same information. There's not one investor who has more information than the other investor, which then translates into the prices of those investments are fairly valued. Everyone has access to the same information, and therefore the prices of those investments, those instruments, those securities are fairly priced. So we have an efficient market. Buyers meet sellers, sellers meet buyers, and everything works in a fluid manner. Sometimes behavioral finance kicks in and it creates an irrationality in the market. One might even suppose that the Norwegian Cruise Line scenario that we talked about, the initial sell-off could have been driven more from a behavioral irrational aberration within the market. Okay, so efficient market theory doesn't necessarily require every single investor to be rational. So if not every investor is going to be irrational, then what it does is it creates pockets of abnormalities, okay, which leads to what we call arbitrage opportunities, the ability to capture excess returns, abnormal returns, when an irrational market exists. So there are limits to arbitrage. We're not going to go through this. Okay, it can be expensive to find those arbitrage opportunities. There's a hedge fund over at off of Greenspring Avenue in Quarry Lake called Campbell and Company. Really great company, really great people who own it and run it. But their whole business is really based upon finding those incremental, minuscule aberrations within a lot of different sectors within the market, pennies difference, and then just doing volume trading to capture that arbitrage opportunity. The problem is doing that's really expensive to implement. Okay. Things like bubbles, all right, can create opportunities. All right, the financial crisis of 08 and 09 was a result of the housing bubble. Home prices were going through the roof because the demand for homes was going through the roof, because a lot of mortgage brokers were issuing mortgages to people who had no business buying the size home that they were buying. So the market prices within the housing market began to exceed the level that was normal and rational. And that bubble grew and grew and grew until all of the crappy mortgages started to fail. And when that happened, everything came apart and then, quote, crashed, like you see here, which is the significant sudden drop in a market-wide value. Okay, so it wasn't just the housing stocks that got crushed when the financial crisis happened. The entire market crashed when that happened. Okay, so it's a significant sudden drop across the market as a whole, not just in one particular sector. And here's some other examples of the crashes. Obviously, the Great Depression, 1929. You have Black Monday in 1987, when there were so many orders that flooded the market. There were no circuit breakers put in place to halt trading. And then finally, by the time all of the orders got processed, the market just absolutely tanked. You have the dot-com bubble in the mid-90s, and then the financial crisis of 08 and 09. We'll talk more about some of these things as we get later into the semester in the investment section of the course. Okay. So when we talk about rational markets, efficient markets, and we're saying that if you believe in the efficient market theory, then you believe that the ability to capture excess returns in a normal market doesn't exist, then why do we have people who manage mutual funds? Okay, mutual funds are managed by a guy in a corner office with a team of people, who are out there trying to build a fund comprised of a number of different holdings with the idea that they're smarter than the market and they can beat the market. But if we believe in efficient markets, then are they really able to do that? And then why should we pay them extra money for something that a more passive investment, like an exchange traded fund, might also be able to offer at a significantly lower price? Okay, so if that's not making sense right now, when we get to investments, we are going to talk more about this. However, even if the markets aren't perfectly efficient, okay, there's still a large degree of efficiency within the market. Right? There will always be these arbitrage opportunities within the market because of the behavioral economics, the behaviors that the investors have, the irrationality that some investors have who participate within the market. So there's always going to kind of be this irrational component even within an efficient market. Right? You can look at this on your own, but it just kind of goes through and compares the performance of a fund manager, okay, here, okay, to what percentage of them actually beat the Vanguard ETF in the market over these years of trading time. Okay, so in reality, oops, where did it go? There it is. Okay, so in reality, you're looking at on average over the last 20 to 29 years of investment time frame, you're looking at about 35% of the time. So about 35% of the time, your highly paid guy in his corner office running a mutual fund would outperform the Vanguard 500 index. Now, the question to you is 35% of the time good enough to warrant paying that fund manager 1% of your assets a year versus paying Vanguard 0.02% a year? Okay, so there is a trade-off there. Okay, so we're getting close to the end here, right? I'm not going to go through this quiz with you guys. If we were in class, we would definitely go through it. But as you rethink the lecture for tonight, okay, and you're getting into some of the questions related to your own personal emotional quotient, start to think about what are some of the similarities and the differences between overconfidence versus over-optimism, okay? When we start talking about time value of money, right, and budgeting, maybe you want to start saving for a really nice vacation after graduation, or maybe you want to start saving for a new car after graduation, and you're looking at your budget and you're trying to figure out how much money you can legitimately save each month between now and that time you make that trip or buy that car, right? Being realistic about how much you can save and not being overconfident or over-optimistic, okay, can make the difference between actually being able to stick with that goal versus the goal coming completely apart, all right? Think about framing. If you're, on the internet and you come across some polls related to things that are going on out there, read them. Think about the questions that they're asking. Think about the words that they're using. And then think about, are there other words that maybe they could have used that would have made me answer that question a little bit differently, right? It's a really important thing to understand, right? And then finally, the last bullet point here, and just something to noodle on. So why does the existence of a cognitive error not necessarily make the market inefficient? Okay, why, when we say, oh, I just made a bad decision, why does that not create a market inefficiency? All right, so that takes us, we kind of talked about the ethics issues when we're going through the polls between those two different groups of people. For example, actually this is a pretty good one. So obviously, abortion is a really big issue and has been for a really long period of time. and you've got, you know, a group of people who lean right, who are pro-life, and you've got groups of people who are on the left that lean more pro-choice. I tend to be more libertarian, kind of down. The older that I've gotten, I've become a lot more libertarian. I'll tell you that right now. All right. I believe everybody should be free to make whatever choices that they feel are best for themselves and for their families. But anyway, so you've got two different polls that might be coming out that relate to the whole subject of abortion. One might be coming out from a right-leaning group. One might be coming out from a left-leaning group. All right. But there's one specific word that one group is going to use that the other group is not going to use that relates to, you know, what's growing inside the woman. All right. What word do you think the right-leaning group is going to use for that individual?
Baby.
Baby or child or unborn child, right? Okay. And then what word do you think would represent the same exact individual, but used more in a left-leaning context?
Fetus.
Fetus. Yeah, exactly. Okay. So we're talking about the same thing. Okay. But the words that we use, okay, are meaningful, right? So when you see these polls and you see the questions that you're being asked, the more you can pay attention to how things are framed, the better responses you're going to be able to give to those questions. Right? Okay. So that gets us to the end of our first lecture tonight. All right, it's an easy transition into our class. All right, next week we're going to hit it a little bit harder. All right, but it's very important that we get this first lecture out of the way so that we can start to understand what our own internal biases are, so that when we start having to make decisions, we make better decisions. That's one of the main tenets of this course. I want to try to help you become better financial decision makers in your own personal life. Okay. Any questions about tonight? Any questions about, you know, the course? Nothing? Okay. If you do, reach out. Again, I make myself available as much as I possibly can. Call, text, email, whatever is most convenient for you. Again, you can hop on a Zoom call whenever you need, but you know, I'm here for whatever might pop up. I look forward to a great semester. This is going to be a fun class. Like I said, it's one of my most favorite classes to teach because I kind of get to cover everything that I think is important for what you're going to be facing when you get outside of the walls of academia. Okay? If that's it, if there's no more questions, thanks for your participation tonight, and look forward to seeing you next week.
Thank you.
Thank you.
Thanks. Have a great night.
Bye.
Bye.
You